Welcome to the 2020 Thomson Reuters Synergy Information Reporting on Withholding 1099 and 1042S update session. My name is Jerry Kahn. I'm a Managing Director at KPMG, and I'm joined today by my colleague Ellis Prendergast, who is also a Managing Director at KPMG. To give you some background about myself, I lead KPMG's Information Reporting on Withholding Tax Compliance Services, which is basically our IRW outsourcing practice. At KPMG, I focus on a wide variety of clients, including large financial services as well as multinational clients. I cover chapters 3, 4, and 61 of the Internal Revenue Code. I also advise clients on the common reporting standards and the related reporting. Prior to joining KPMG, I worked at Barclays Capital Investment Bank and the Bank of New York Mellon, where I focused on the automation of the information reporting and withholding process. Ellis?
Hey everyone, good day. My name is Ellis Prendergast. I am a Managing Director at KPMG's Information Reporting and Withholding Practice. Similar to Jerry, I've spent a considerable amount of time as not only an advisor here at KPMG, focused on Internal Revenue Code Chapters 3, 4, 61, the Foreign Account Tax Compliance Act and the relevant provisions, or FATCA, the OECD's Automatic Exchange of Information provision, commonly referred to as the Common Reporting Standard, or the CRS. But I've also spent an amount of time in industry in an information reporting and withholding role. So my function here at the firm is to provide our clients with, operational and tax technical advice, and the interplay between the rules and how to comply with them is where I focus on my efforts. So Jerry and I have a packed agenda for you today. I know Jerry's going to talk about the agenda in a moment, and we're going to lay the law in terms of how we like to keep the time. But before doing so, I want to just quickly go over to the next slide and talk about some of the house rules really quickly. So logistics and CPE information, there are 5 points that I have to cover. I'm going to cover them in the order presented. So the first one is that this session has been pre-recorded. However, a subject matter expert is participating in the session live today to answer your questions using a Q&A panel. To verify your attendance and for you to qualify for CPE credit, please ensure that you acknowledge all attendance pop-up alerts. Thirdly, be sure to complete the survey session to provide us and Thomson with some valuable feedback. Fourth, CPE credits for attending this session live will be added to your Synergy CPE certificate that will be emailed to you at the end of the conference. And then lastly, the recording of this session will be made available post Synergy, but unfortunately, that recording will not qualify for CPE credit. Jerry, I'm going to kick it off to you. I know we've got a packed set of content, and I know you want to lay down some law in terms of objectives and agenda. And Jerry, I think you might be on mute for a moment.
Yeah,
It
thank you,
happened.
Ellis.
We
And
want to
before I
apologize.
jump into the objective and the agenda for today's session, just want to say thank you very much for joining us today. For the folks listening, Ellis is fresh off of eye surgery. So
Nice.
if you see one eye looking a little bit weak there, he's not winking at you.
Yeah, I am not winking at you intentionally.
All right.
Thank you for that.
Yeah. Okay, so to go over the objective, our objective is really to get you all some basic background on 1099 and 1042S, the Chapter 3, 4, and 61 regime that relates to that, and to also provide some updates relating to 1099 and 1042S. Like Ellis mentioned, we've got a jam-pack slide deck here. It covers a lot of material that we will not be going through in very detailed content. So essentially our focus will be on the 1099 and 1042S content. We have lots of material related to FATCA, the Common Reporting Standard, partnership reporting, etc., that we will touch on at a high level so that you're aware of them. But we have provided the detailed material related to that in the slide deck, so feel free to read through that for those that are interested in some additional detail there. In terms of our agenda, we'll start off giving you a brief overview of the information reporting and withholding regime, specifically chapters 3, 4, and 61, its key components, and some risk of non-compliance. And then the bulk of our presentation will be focused on some recent development in the IRW regime, as well as some practical consideration for withholding agents. To start us off so that everyone gets on the same baseline, we just like to use this slide to frame up the information reporting and withholding regimes for U.S. withholding agents. Essentially, as a U.S. withholding agent, your information reporting and withholding obligations start at the time you're making payments. So in the event that you're making payments to U.S. people, you're on the left side of this grid, where for U.S. people, from an Internal Revenue Service point of view, they care about our worldwide income. So U.S. source, non-U.S. source, gross proceeds, the IRS wants to know about that. And the way they know about that is by way of requiring U.S. withholding agents to report our activities on what's called a Form 1099. In the event that a U.S. withholding agent has not collected a TIN in the appropriate format from a U.S. person, they're required to withhold the maximum back of withholding, which is 24%. And that's 24% withholding on all U.S. sourced FDAP payment, non-U.S. sourced FDAP payment, and gross proceeds. Now, if we look to the right side of this grid, it highlights the requirement when a U.S. withholding agent is making a payment to a non-U.S. person. And when we're making a payment to a non-U.S. person, the real focus there is on U.S. sourced FDAP. And what FDAP is fixed determinable annual or periodic payments. What that means is if you're outside of the U.S. and you're making non-U.S. source payment to a non-U.S. person, the IRS is not requiring you to do something with that for U.S. tax purposes. However, if you're making a U.S. source payment to a non-U.S. source person, that's where you have an obligation. And the way the rules work is the Chapter 4 rules, which is the FATCA rules, get applied first. Essentially, you're looking for someone that's participating with FATCA, which means 0% withholding, or not participating, in which case you withhold 30%, you stop there and you report that. And after you finish with FATCA, if someone is not subject to withholding under FATCA, then you go to the Chapter 3 rules to see if there's any type of withholding related under the Chapter 3 rules. And that's where someone would give you a W-8, for example, to claim any kind of treaty reduction in the event they qualified for that. Under the Chapter 3 rules, the maximum withholding applies. They start off at 30%, and then someone would give you a W-8 document to claim anything other than 30%. The reporting that goes with the Chapter 3 and Chapter 4 regime is generally Form 1042S reporting. Moving on to the next slide, we'd like to cover what is the main point of each of these regimes. So we talked a little bit about 1099 reporting, also known as the domestic tax, all fall under the Chapter 61 of the Internal Revenue Code. And the main point of this reporting is really disclosure to the IRS. The IRS really cares about, like I mentioned, the worldwide income of its U.S. people. And what it's trying to do is have something to confirm your income tax return, your 1040 return against. So withholding agents will give a copy of the 1099 they provide to an individual or an entity that will then do income tax return. And for those that work a 9-to-5 job, you may also be getting a W-2. The IRS will take your 1099 and your W-2 to get a holistic view of your income for that year. So it's really a way for them to monitor compliance. Under the Chapter 3 regime, it's really that regime exists as a mechanism to ensure foreign persons are paying their fair share of taxes. And like I mentioned, the Chapter 3 withholding starts off at 30%, but someone can say, could prove to you that they qualify for a reduction in that either based on treaty or based on the Internal Revenue Code exceptions, etc. And the Chapter 4 regime is really, think of that as a big stick to force foreign financial institutions to disclose their U.S. people or else face the consequences, which is essentially 30% withholding taxes on all U.S. source FDAP payments. This next slide really frames up the way withholding agents generally approaches information reporting and withholding compliance. You first start off with your payee profile, which is usually done during payee onboarding and its maintenance process. The next key aspect is understand the type of payments you're making, whether or not it's withholdable, and if you do withhold, what is the process for remitting those withholding to the IRS. The third bucket here is bringing it together. You've got your payee classification, you've got your payment classification, bringing those together to determine the appropriate withholding rate and also determine what's the appropriate reporting that should occur. And the last bucket here is just the year-end reporting process. This is when you create your 1099, 1042S, 945, 1042, etc. And now there's a fifth element here, which is governance, and it cuts across all four of these work streams. You want to make sure that you're on an ongoing basis, you're monitoring your system for compliance. As part of your onboarding process, one of the key elements is documenting your payees. So who are you making payments to? Payees have the obligation to figure out what form is appropriate for them and provide that form to the upstream withholding agents. So the payee will determine which of these forms is appropriate. This is a guide so that you understand what forms to expect based on your knowledge of the payee. So a U.S. person will typically be submitting a W-9. A foreign individual will give you a W-8 BEN. A foreign entity that's the beneficial owner of the income will give you a W-8 BEN-E. A foreign entity that is that's receiving payments, that's basically ECI, they'll give you a W-8 ECI, which means that the source of that payment is connected with a trade or business in the U.S. A foreign government or a tax-exempt org will give you a W-8 EXP. And in many instances, you've got intermediaries, partnerships or flow-through, which means they're not the end beneficial owner. They'll give you a W-8 IMY, and where appropriate, they'll give you a withholding statement as well as the underlying beneficial owner documentation. Now, the one I skipped over here is the Form 8233, which is applicable to individuals performing independent personal services. The key thing to know about the Form 8233 is typically used by individuals to claim exemption from withholding. And once you receive an 8233, there's a process where you'll need to submit that to the IRS and give them a period of time to let you know if this person does indeed qualify or does not qualify for withholding, any kind of withholding exemption. In the absence of documentation, you're required to apply the presumption rules. And the key thing to take away about the presumption rules is for US people, it'll get them to the worst category, which is a non-exempt payee subject to 24% backup withholding on all US and non-US sourced income as well as gross proceeds. For folks that are presumed to be non-US, they would typically be presumed to be non-US, non-participating foreign financial institutions, or one of the other institutions subject to 30% withholding. So under the presumption rules, payees typically get the worst status and has to pay the maximum amount of withholding. So why should withholding agents care about compliance with information reporting regime? The IRS, as a result of FATCA and as a result of expanding its team, has been increasing its audit nationally, has over 3,000 examiners that have trained and are in the process of initiating audits across the country. So it's definitely a focus area for the IRS. As a result, it should definitely be a focus area for U.S. withholding agents. I'm not, as I mentioned at the start of this deck, there's a lot of material to cover. I'm not going to go through every single slide in excruciating detail, but feel free to read through some of these related to additional penalties, etc. on your own. We've included the content in the slide deck so that you have that as a takeaway. And that brings us to our first knowledge check. I'll give you all a couple of seconds to review and respond to this.
But only a couple of seconds because we got a lot of content to cover.
Fair enough. Hopefully that's enough time. Moving along, we're on recent development and information reporting on withholding, as well as kind of a recap on some of the key aspects of the 1042S and 1099 season. This year, in the middle of 1042S reporting season, COVID came and basically disrupted the world as we all know it. On top of that, the IRS did not formally offer any kind of extension to the 1042S or the 1042 due dates. We've had lots of withholding agents struggle to get their forms out timely, mainly because they were in the process of relocating their people and adapt into the work from home environment. For withholding agents that did have challenges with filing 1042-S and 1042 timely this year, we do encourage you to consider filing for an abatement. Withholding agents did raise a request for the IRS to have some kind of a standardized abatement process this year, but the IRS has yet to comment on that publicly.
So I'll start talking about some of the FAC and CRS reporting extensions here, Jerry, that are COVID related. So Jerry mentioned that the 1042-S and the 1042 did not get a formal IRS extension, and the opposite is true for FAC. So the IRS extended the deadline for FACA reporting via Forms 8966 from March 31st, 2020 to July 15th, 2020. So to the extent you are a Model 2 or reporting Model 2 FFI, a participating FFI or a United States withholding agent that otherwise would report on a Form 8966, you were eligible for that automatic extension without the need to file some sort of extension request. The European Union amended DAC 2 similarly to provide member states with the option to defer CRS deadlines, or CS reporting deadlines, by 3 months. What that means is that it gave EU member states the ability to defer CRS reporting. And on the heels of that, the IRS decided to further extend its deadline for Model 1 jurisdictions to provide the IRS with FACA-related information. So they actually extended that due date all the way up until December 31st of 2020. They did so in order to provide Model 1 jurisdictions with the opportunity to extend local deadlines as needed. Next slide, please. So, as expected, many jurisdictions took avail of either the EU extensions or the IRS extensions and extended either their local FACA or their local CRS reporting deadlines. Jerry and I are talking to you in late October, early November. So of the date of this recording, what's really relevant for us right now is Cayman Islands reporting, both for FACA and the CRS. At the point in time that we're in now, that reporting is due November 16th, 2020. Admittedly, at the point you guys are listening to this, that due date may have changed. And I say that because as of the date of this recording, the Cayman Islands has yet to open up their FACA and CRS portal. And Jerry snickers. I think you want to see a comment. If so, feel free to jump in, Jerry. But I know you're going to mention that you expect to see a further delay. Is that?
Yeah, I mean, if history repeats itself, typically withholding agents all try to get on the Cayman portal at the same time and submit their files. And I mean, as you get closer to the deadline, it's often QSENT and typically have a lot of issues. I don't think 2.5 weeks will be enough time for withholding agents for FIs rather. Sorry, I didn't mean to say withholding agents there. For FIs to submit all their reporting to the Cayman Taxing Authority in a 2-week period. So, the hope is there will be some kind of relief or extension.
Yeah, I would agree. I mean, if history or experience tells us that there's going to be some sort of increased burden there. Moving along to the next slide, there are a couple of other jurisdictions that also amended, most of which, if not all, at this point have kind of finished their FACA reporting. There are some delays pending. So St. Vincent and the Grenadines, unfortunately, the portal is down. It's been down for a while, and consequently, reporting has been suspended. At this point in time, we're not sure when the portal is going to be reopening and when the jurisdiction will resume its FACA reporting requirements. Interestingly, there are a few jurisdictions that chose not to extend or formally extend the FACA reporting. Instead, what they told reporting financial institutions to do is to report in their, based on good faith efforts, and to come into the tax authority and seek relief if needed. Japan under reporting model 2 under reporting model 2 IGA went with this approach, and the United Kingdom under reporting model 1 IGA went with this approach. So a couple of other certification extensions. The first of which is still related to FACA. So to the extent your FACA classification requires you to designate a responsible officer, and to the extent that responsible officer has a certification requirement, the IRS, and And also, to the extent that you haven't completed this and you have a due date of July 1st, 2020, the IRS has automatically extended that due date for you to December 15th, 2020. The extension is automatic. You don't have to go into the portal and fill anything out. So similar to your 8966 extension, it's been done on your behalf related to COVID. Um, QI, or Qualified Intermediary, Withholding Foreign Partnership, or WP, and Withholding Foreign Trust, or WT, to the extent you have entered into any of those agreements and you have a corresponding certification that's due July 1st, 2020, that also has been pushed to December 15th, 2020. Similar to the FATCA RO certification, there's nothing that the responsible officer for the QI or WFP or WT has to do to get that. Note that, with respect to the extensions of QIs and WP and WT certifications, it's important for you to understand that there's still a lot of significant advanced work that needs to be completed in order for you to complete the appropriate certifications. So, to the extent that you haven't begun determining which year you're going to review, undergoing the periodic review process, selecting samples, reviewing documentation, etc., we encourage that you do that as soon as possible because you are going to need to make a certification quite soon. Lastly, here I'll touch on is the qualified derivatives dealer certifications. And I know, Jerry, thank you for going back 1 second. I'll just note here that Notice 2020-2 extended 871M provisions, including those related to QDDs. And as such, there isn't a requirement for the QDDs to certify or to perform some sort of periodic review until 2023. Moving on to the FAQ updates. So we've listed out the 3 updates that were made to the frequently asked questions portal for QIs, withholding foreign partnerships, and withholding foreign trust. We won't go through them in detail, but to the extent you're interested in seeing what the changes are, we've listed them out here for you for your consideration. And then something that's probably very interesting to the folks that are attending today. I know Jerry and I in our practice, this is very interesting. We've gotten an update to the substantial presence test. For those of you that are familiar with this test, essentially there is a mathematical computation that we use that takes into account the number of days in which a foreign individual has resided within the U.S. to determine whether or not we should treat that person as a U.S. person. So to the extent that the sum of the days in a rolling 3-year period exceeds 183 days, we treat that foreign individual as a U.S. individual. Midway through the year, around February or so, Revenue Procedure 2020-20 was released, and essentially what we were able to do there is that Revenue Procedure 2020 allowed the for an individual to exclude up to 60 consecutive calendar days between February 1st, 2020 and April 1st, 2020 from that computation. And the intent here is to kind of alleviate some of the undue burden associated with the COVID-19 emergency travel disruptions. In order for you to qualify for this exclusion, you do need to be an eligible individual. We've listed out who qualifies for an eligible individual. There are certain, carve-outs that make sense, such as, that you weren't otherwise you were otherwise a U.S. resident at the end of 2019, or you weren't otherwise a lawful permanent resident at any point in 2020. That said, this is a substantial win for a lot of folks who felt stranded in the United States during that time. Similarly, and this is another big win for folks in respect of COVID, is so lenders who issued loans to borrowers or to recipients pursuant to the Paycheck Protection Program, or PPP, and then they subsequently forgave those loans because the recipient was otherwise eligible for forgiveness under the CARES Act, do not have a corresponding requirement to file Forms 1099-C. In a similar context, if you're a borrower and you forgive a loan if you're a lender and you forgive a loan to a borrower, you may trigger a reporting responsibility under 6050P related to the cancellation of debt. Well, this announcement otherwise suppresses that responsibility for these particular types of loans. And Jerry's going to cover the electronic forms and signatures.
We're covering some additional relief the IRS made as a result of the disruption caused by COVID-19. The IRS recognized that many people are working from home, and therefore the standard process for getting documentation signed will be much more difficult with a lot more substantial delays. The IRS passed a memo in March of 2020 that basically allowed scanned signature, digital signature, electronic signature, etc., on many tax-related documentation. From a US IRS perspective, we have formal guidance that the forms W8 can either have an electronic signature or scanned signature, etc., included with it. Note that this guidance did not extend to cover forms W9, and the reason for that is different groups within the IRS covers guidance for W8s than the W9. Lots of nuances, lots of exceptions, etc. We've included the content. Feel free to review the material. We're not going to cover everything in great detail. This other section here, where there's some updates, requires some background information because it relates to an area we haven't covered in a lot of detail. You're all very familiar probably now with FATCA. FATCA did have a requirement for foreign financial institutions to also withhold in its early days. As a result, many foreign financial institutions went to its local government and put pressure on the local government to enter into what's called an intergovernmental agreement with the US, essentially as part of the IGAs, with FIs in those jurisdictions that participated did not have to actually withhold on behalf of the IRS and deposit the withhold into the IRS. So what ended up happening is, in order to encourage more jurisdictions to basically enter into an IGA, the IRS agreed to share information with those local jurisdictions. And the way it gathers information that it's going to share is on the form 1042S. So in come the requirement for the withholding agents to start collecting foreign tax identification numbers from foreign persons. This way, when the IRS shares information with the local jurisdiction, they're able to make a positive identification. Now, the requirement went into effect in 2018 with additional transition relief, which expired December 31st in 2019. So 2020, from January 1st, 2020 onwards, is the first time that all foreign persons that are required to provide a foreign TIN were required to provide that foreign TIN for the entire year. What that means is that that transition period where the IRS wasn't strictly enforcing FTIN for folks that fit the right profile on a 1042S has now expired. So from 2020 onwards, all foreign persons that require FTIN are expected to have that FTIN reported on the 1042S that U.S. withholding agents send to the IRS. And in the event that it's not included there, we expect the IRS to issue penalty notices related to that. I'm going to skip over some of the nuances and some of the exceptions related to FTIN, and so we can get through all the material and focus in on an area that I think everyone's really interested in, is some changes to the 1042S itself. Many changes occur specifically around the Chapter 3 status codes. And the one key area is the elimination of U.S. withholding agent FI, U.S. withholding agent, other U.S. withholding agent, foreign branch of an FI, which is Chapter 3 status codes 01, 02, and 34. These have been removed. And the reason for that is simply because the IRS wants withholding agents to use their actual classification for Chapter 3, and the fact that the IRS gets this information already from withholding agents Chapter 4 status. What that means is, if a withholding agent is a corporation, they should use Chapter 3 status code 15. If you're a partnership, you should use Chapter 3 status code 08. Additional changes that are relevant here is the change for income code 19, which previously was used to represent foreign government. The foreign government classification has now been split into two. It's now income code 36, which is for entities that are integral part of foreign governments, and income code Status Code 37, which are controlled foreign entities that are controlled by foreign governments. A key aspect to highlight here is that Chapter 3 Status Code 19 has been recycled. And instead of referring now to foreign government, it's now referring to international organization. This is a key area to stop here, pause, and highlight for withholding agents to take note of, because many instances that we've seen, the extracts that come out of source system to go into either your in-house reporting system or your external reporting system or your outsourced provider, typically includes the Chapter 3, Chapter 4 code automatically based on the documentation on file. So you want to make sure you work with your IT team to get the code updated on the back end.
Yeah. So this is always low-hanging fruit for the IRS. Am I right in thinking that, Jerry?
Absolutely, absolutely.
So I'm going to spend some time, and really quickly focusing on the guidance associated with the lag method and the proposed reporting changes associated with it. So this topic is covered in slides 35 through 43 of the deck. We're really going to focus on slides 36 and 37 probably, and then to the extent that you have to the extent that these rules are applicable to your organization and you're trying to figure out how to report a particular payment. We've provided you with reporting scenarios in the subsequent slides. So find the appropriate scenario that fits you, and you should be able to see how you're reporting if it changes to the extent it does. So under the lag method, income earned by a partnership in year one that's not otherwise distributed by that partnership in the year is treated as paid to a non-U.S. partner in that partnership on the earlier of the actual distribution or the partnership's K1 reporting date, which is typically September 15th of the following year. What does that mean? That means that withholding under the lag method occurs at the time the actual payment. So if there are no distributions, it's typically going to be in the deemed distribution that's made in the subsequent year. The deposits associated with that withholding are deposited for the year of withholding, so year two. Therefore, again, if no distributions in the year in which the income is earned, therefore there's no withholding. And then lastly, payments are reported in the year in which the payment actually occurs. So the result of the lag method is actually it pushes back the withholding requirements, the deposit requirements, and the reporting requirements. Under the proposed changes, there are going to be no changes to the actual withholding rules. So the withholding is still going to occur exactly like it does under the lag method. However, deposits are going to be attributable to the year in which the income was earned by that partnership, even if the withholding happens in a subsequent year. So what that means is that when you've chosen to withhold in year two for income that's earned in year one, we're going to remit that and annotate it to the service as a year one deposit as opposed to a year two deposit. And more importantly, payments are going to be reported for the year in which the income is earned by the partnership, even if the withholding occurs in a subsequent year. What that means is that if you have a withholding event occur in year two, you still will need to report it as a year one. You'll need to report it on a year 11042S. And to put it contextually is if you earn income in 2019 and you don't distribute it until 2020, you're going to have a withholding obligation at September 15th, 2020, but you're going to be required to deposit it associated with the 2019 tax year and report it associated with the 2019 tax year. Importantly here is that fiscal year partnerships can elect to remain on the current lag method, but calendar year partnerships will not have that election. One slide over, please, Jerry. So Jerry covered, actually one more slide over, I'm sorry. Jerry covered, the changes to the Chapter 3 status codes, and in particular, the IRS requesting that our Chapter 3 status code now drill down to the U.S. tax status of the withholding agent, whether that's corporation or not. And the reason why that's being done is so that the IRS can know, or the IRS is at least put on notice for withholding agents that are partnerships and withholding agents that potentially may be reporting under this new set of rules. So one more slide over. I apologize about that. I want to show the group here, right? That's perfect. I want to show the group here an example. So this is an example of a partnership who's chosen to use the proposed reg method, and you'll see that the way in which they'll report that to the IRS this year is that they're going to check box 7C of the Form 1042-S, and that lets them know that the withholding was performed in a subsequent year, and they're also going to make sure that they are reporting themselves as a partnership in their Chapter 3 status. So these rules are quite complex. There are different, conclusions based on the different scenarios in terms of whether or not there's deemed distributions or actual or a mix of the two. We've provided you guidance throughout here, and during the live session, I'm happy to kind of walk through particular questions that may arise. And that brings us to our third info check. So we'll just take a moment for you guys to quickly respond to that before moving on. Okay, I think that's good there. So again, we've provided you with a couple of more slides on the lag method. Again, to the extent that there are a lot of questions, I'm happy to talk about them during the live session and answer questions. I think we are going to move on to Forms 1099 NEC
Yeah.
next.
Yep. And Ellis, the one key thing that I want to make sure everyone takes away, for those that do have requirements as a partnership and will be reporting under the lag method, the key takeaway from Ellis's point earlier is to ensure that on the 1042-S, you're appropriately checking box 7C to let the IRS know that this isn't late reporting, this is reporting that is due by September 15th, because that's where the IRS will be looking at to ensure you're not, to basically, when it's assessing penalty, that's where the IRS will be looking at. And based on that, it'll decide whether or not it's a late filing or not. Another key aspect of this is while the 1042-S has an automatic extension for September 15th, the Form 1042 does not. So you want to make sure you apply for a Form 1042 extension by filing Form 7004. So this way the 1042 and the 1042-S due dates are aligned.
Yeah, definitely good points, Jay.
Okay. I'll briefly cover the Form 1099 NEC, and before going into the Form 1099 NEC, I just want to quickly recap the history here. The information that is now going to be covered on Form 1099 NEC used to be on the Form 1099 MISC Box 7 for non-employee compensation. Essentially, because you had independent contractor reporting on the 1099 MISC where Box 7 was reporting the independent contractor information, and you had 1099 MISC reporting for other things, including gambling, winnings, other payments on box 3 or fishing proceeds, etc. You had a misalignment of due dates. So essentially you had a situation where the one form 1099 MISC was due to recipients on January 31st, but if you had box 7 reported, it was due to the IRS, whether you file electronically or on paper, by January 31st as well. However, if you had reported in any other area in the form, you had until the end of February if you're paper filing and the end of March if you're e-filing. Caused a lot of confusion. Lots of people were getting penalized because typically you would report to the recipient and then report to the IRS sometime before the March 31st deadline to ensure you have any amendments, etc., handled before you file with the IRS. So to help alleviate some of the burden and some of the confusion, the IRS took out box 7 from 1099 MISC and created its own form and called that 1099 NEC, or non-employee compensation. A couple of key points here. The Form 1099 MISC is now due to the IRS at the end of February if you're paper filing and the end of March if you're e-filing. And it also now has a substantial change in that box 7 has been removed. So you'd want to ensure that any queries you're pulling from your source system is appropriately updated. Now, Form 1099 NEC is a brand new form. So you want to make sure you're working with your IT team as soon as possible to get new extracts out of your system into the appropriate format for this to generate Form 1099 NEC. The other key aspect here is is in addition to ensuring you have your technology updated, you want to make sure um, you are keeping track of the data in your system to make this process as easy as possible towards the end of the year. Other things to be aware of is now that this is a new form, folks that participate in the Combined Federal State Program may actually have an obligation now to send the 1099 NEC records directly to states, to certain states that are not ready to receive this information from the IRS. So it's something that you should be watching closely and keeping track of where you have additional obligation at the state level. And for those that want additional information on the 1099 NEC process, we cover this in a lot more detail in our state and local session. So I encourage you to check out the information report and withholding state and local session. This is a sample of what the form 1099 NEC is going to look like. You'll notice nothing out of the ordinary, nothing that you wouldn't expect to see, but it is a new form, so bringing that to your attention. And that brings us to our next knowledge check. I'll give you a couple of seconds to review and respond. Okay. This next one is a Form 1099-R and 5498. Again, this is another one where we covered in a lot more detail in our state and local information reporting and withholding section. One key thing that we wanted to point out here, there was some alleviation for reporting during the 2020 season. Also, a key thing to highlight is that beginning in 2020, taxpayers with earned income can contribute to its IRA even after age 70 and a half. Which is the same, which now aligns the IRA rules with the 401k and the Roth IRA rules. Another thing that I wanted to point out is for those of you that have the obligation to report bank deposit interest, you'll know that for individuals, you're only required to report bank deposit interest in certain jurisdictions. Singapore has now been added to that list. So you want to ensure you work with your IT folks to add Singapore to that list. As a side note, typically in our experience, withholding agents report individuals for all jurisdictions. This way you don't have the additional obligation to maintain the list year over year.
I'll quickly touch on this one, Jerry, if I may,
Yeah,
with
thanks.
respect to the Cayman CRS compliance form. So, as it comes to no surprise, right? So, Cayman Islands has began to kind of increase its enforcement efforts related to various regimes, including but not limited to, the common reporting standard. So this is a new filing requirement, right? So the filing requirement for this year will be December 31st, 2020. But going forward, it's going to be due September 15th in subsequent years, right? And essentially, in addition to our substantive or nil reporting requirement, the CRS compliance form has to be completed by reporting financial institutions, and it's designated to ensure that the FI is complying with not only the reporting requirements but the due diligence requirements of the regime, in addition to kind of the documentation requirements and the overall spirit of the regimes. So what they're going to have to report on an annual basis is the total value of all accounts, regardless of whether or not they were reportable or not. The number of non-reportable accounts, right? So how many accounts did you hold that you didn't end up reporting? The reason as to why you didn't end up reporting, the aggregate value of those accounts, and it wants to understand some of the interplays of your compliance requirements, right? So it's going to ask you questions about policies and procedures and certain compliance functions of the reporting FI. So this is a very new rules regime. It's actually the first time that it's being rolled out. It will also be on the portal, just like the FATCA and CRS reporting is. And Jerry and I mentioned that the portal's still not up. But what we do have here is a quick snapshot of some of the questions we expect them to see. Some of the ones we've highlighted in yellow here are the ones that we find particularly interesting. But yeah, we see this as the first major jurisdictions that doing this for the CRS. I imagine that other jurisdictions will also follow suit. So it's interesting. Yep. Moving along that vein in terms of risk, Jerry, do you want to talk about U.S. risk?
Yeah, absolutely. On the US side, I mean, all we really want to highlight on this slide is the IRS, like we mentioned earlier, in addition to beefing up enforcement, continue to increase the penalties associated with late filings. And you'll see here that for late filings that occurs after August 1st, it went from $260 for late IRS version copies, as well as $260 for late copies to the recipient. Um, to this year in 2019 for 2019 reporting, it went up to 270, and then next year for 2020 reporting, it's going to go up to 280. In addition to having the per form fee increase, the maximum penalties, the IRS charge has also gone up year over year and will continue to go up as well. To talk a little bit about the increased exam risk, the IRS has been pretty verbal about what they're looking for, and the IRS audits today is very different than the way IRS audit has been historically. Historically, the IRS have focused more on the minutia, which is more on the forms being completed appropriately, the W-8s and the W-9 matching perfectly to the form, and that's it. Now the IRS audit is a lot more expansive. They're looking at what type of payments you're making. Have you classified those payments appropriately? Do you have any big areas where you're making payments and just not reporting those correctly? They're also looking at your policies and procedures. They're looking at flow charts. We really see the IRS taking the time to really understand the unique facts and circumstances for specific withholding agents and auditing them that way, looking for the big misses rather than the little minutia miss. They're a lot more organized. They have regional audit teams that go out there and perform these audits. So our advice to withholding agent is do what you can to get prepared and over prepared for these audits. So, I mean, just to keep us moving, what should companies be doing right now in order to be compliant with information reporting? So, and what are companies doing? We've seen an increase in companies doing either internal health checks or reaching out and doing external health checks, whereby folks take a look at the different areas of compliance that we talked about earlier, whether it's onboarding, customer maintenance, payment classification and withholding, um, year-end reporting, the governance process across it all, the policies and procedures that's in place. People are really starting to spend time ensuring that the organization is as compliant as possible. We also see organizations, doing sample reviews of the documentation you have on file, sample reviews of the withholding that's been applied and the associated deposits to the IRS, as well as doing sample review of the actual reporting that went out the door to recipients. Whereas historically, people have basically sent this off to a third party and just kind of pray that it's done correctly. We see people now looking at things a lot more closely to ensure their compliance level is high. Other things that we're seeing people do is proactively looking and trying to fix any areas where they've identified delinquencies. And for example, if you've got W-8s that were completed incorrectly, but you accepted it and you get favorable treaty, you do have the opportunity to go back a year, get a W-8, and get a retroactive statement from the counterparty or vendor saying that the W-8 that they provide applies for a prior year. So we see a lot of people basically taking those type of steps to increase their level of compliance. Ellis, anything to add there?
No, I think you've covered it all, right? I think it's taking a look and assessing, your compliance against some of the steps that are outlined in the Internal Revenue Manual, right? In particular, the section that you covered, Jerry 4.10.21, will get you a long way there. To the extent that you don't have that capability and you want someone like internal auditor or your some sort of other service provider to do that, that's what I would encourage you to do. If there are problems there, setting up some sort of remediation process to get that, right? So one way, as you mentioned, is collecting those forms. Another way is getting sourcing statements in the vendor world, performing 10 validation checks early on. So there's a litany of different things that you can do to prepare for a potential audit.
Yeah, and the last part that I want to comment on here is in the event you've identified a big miss, a massive area of non-compliance where you actually owe withholding dollars to the IRS, we encourage you to consider um, joining the IRS Voluntary Disclosure Program, where you basically raise your hand and self-identify as having this issue, work with the IRS, and basically ask for some kind of abatement on any penalties related to the late filing. Of course, you'll be making any owed withholding deposits with them through that voluntary disclosure program. That brings us towards the end of our presentation. We did want to spend a couple of minutes talking through what are some of the options available to you for compliance and when does one option make sense versus another. So for example, right now as a result of COVID and as a result of a change in the marketplace, people are withholding agents are actually having a debate whether or not to continue investing in in-house technology. When does it make sense to make that investment? So for example, in-house technology generally makes sense to invest in the event that you have people with strong information reporting and withholding skill sets and availability of IT resources to dedicate to building out new things as well as maintaining any information reporting specific tools that you have in-house year over year. We've included a lot of detail on when different things make sense. Another aspect is when does it make sense to actually look externally for vendor technology? In the event that you don't have that in-house expertise and you don't have an in-house reporting tool that you're tied into, it might make sense to consider an external technology if you've got great volume and you don't have the right skill sets in-house because somebody else will then have the obligation to maintain that system. Of course, you want to make sure that you're staying on top of your in-house preparation, your query extract to take data off of your system that gets fed into that vendor technology. But in this, with a vendor technology, you don't have to make that investment, the technology investment. And then for other kind of clients, maybe you have less volume, maybe you just don't have um, enough resources to cover the work. You should explore when does a co-sourcing model make sense, or maybe even a full outsourcing model makes sense, in which case you send your raw data to somebody else and have them do all the reconciliation needed and basically prepare the 1099s, 1042s and send them out to your recipients and send copy to the IRS, in which case your team just function purely as a reviewer. I think any of these options make sense and can lead to a high level of compliance. You just have to do your own assessment to see what's best for your organization based on your size, your profile, in-house expertise, etc. During the live session, happy to take questions and comments on this piece. I think with that, we're towards the end of our presentation. I'd like to thank you all for sticking it through with us and making it all the way to the end here. It's been my pleasure being here with you all once again. And just want to say have a good rest of your day and enjoy the rest of the conference. Ellis?
Yeah, thank you all for attending. Jerry and I can talk about this for hours. We try to do our best to talk, to keep it to a 15-minute session. Look forward to engaging with you guys later on about this. Take care, everyone.
Take care.